before we get into how climate risk is affecting real estate in practice, we will start with some establishing a framework. And with that, Dr. Ankersen, you can get us going on your perspective.
Thanks very much. Pleasure to be here. I know absolutely nothing about real estate except that I've lived in it all my life, so I suppose that makes me somewhat of an expert. I'm going to talk about risk because I think it's a very poorly understood concept, although it's ubiquitous. And I think the first thing I would say is that in order to talk about risk, there are two preconditions which exist in all aspects of risk, especially in real estate, especially when we're talking about climate. The first is uncertainty. If you don't have uncertainty, then you're really not talking about risk. There'd be no requirement to bother to do a risk assessment or some kind of risk-based approach if we didn't have uncertainty. And of course, uncertainty comes in two different flavors, we might say. The first is what we might call knowledge uncertainty or epistemic uncertainty, stuff we don't know. And a lot of effort goes into trying to correct that. Can we get more data? Can we wait for one more study? Can we get some more opinions on things to try to increase our knowledge about what it is we're worried about? But the second aspect of uncertainty in some ways undermines that, and that's just the variability of the system or the subject we're talking about. It's got nothing to do with how fine our microscopes are or how big our databases are. It's just the variability and volatility of the system itself that makes it unknowable to an extent. And I think when we're talking about climate risk especially, we're very much more in the second camp than in the first. Waiting for one more study, waiting for one more line on an Excel spreadsheet isn't really where we are. It's very much more now about the unknown or the unknowability about the system itself. So we need to have uncertainty, otherwise we're not talking about risk. The second thing we need to have, and this may seem counterintuitive, and that is scarcity. If we had unlimited resources, unlimited time, unlimited bandwidth, unlimited money, we wouldn't have to worry about a risk-based approach either. We would just do everything all the time, everywhere. So unfortunately, we need to make decisions. We need to have priorities. We need to make resource allocations based on those. And of course, those really are the devil in the details. Risk management at the end of the day is really just an aid in decision-making, and it comes down to that every time. The second point that I want to make is that risk, sadly, as I said, is poorly understood. Of course, I would say that as an academic. But it's made up of four elements that are often used as synonyms journalistically or kind of in sloppy writing. The first is that we talk about a threat or an opportunity. That's an element of risk, whether we're talking about something that can do harm, we would call that a threat, or we might call it an opportunity if it's something that can give us a boon of some kind. But those are not synonyms, right? We can't just say the risk is the hazard, the risk is the threat. We have to go a little bit deeper. We need to look at vulnerability. Vulnerability is the exposure. How exposed are we to those threats or opportunities? And of course, different buildings, different portfolios are going to have different reactions, even in the presence of exactly the same threats and opportunities. The third element is probability. What are the odds that the good or bad thing will actually take place? And again, a lot of effort is put in here. This is the probability is where we try to measure or get a grip on this notion of uncertainty. And then the last, of course, is consequence. And again, this is fairly easy. The risk approach is rather agnostic, whether we're talking about a good consequence or a bad consequence. To a certain extent, this is not an objective measurement. It's very subjective. Do you find something to be a plus or a minus? Can often have to do with your position, to do with your interests. The point being, all four of those elements need to be taken into consideration. We can't just have a kind of sloppy shorthand where when we're talking about risk, we're only focusing on threats, or we're only talking about probability, or we're only talking about consequence. We need to look at the function of those four factors together, and that makes risk an extremely powerful, as I said, aid to decision-making. But at the end of the day, and hopefully we'll hear from the other panelists who are actually in the position to do this, all that risk actually is about is trying to help make decisions. And that, of course, is extremely difficult to do. There is no magic wand. There is no silver bullet here. The best risk-based approach, if it's a 72-step process, isn't going to do very much other than provide that kind of information, the gut feeling, as it were, for a decision maker to make that decision. And with that, I'll pass it on to the next
that was really helpful. Thank you. I think we're going to move on to Jessica. If you could tell us a bit about, firstly, the differences between transition and physical climate risk in real estate, and then what you're seeing in Nareit and how you guys help the industry understand what's going on.
Yeah, thank you. I am the opposite. I've spent my entire career in commercial real estate, really just pointing out that real estate is all around us, right? Where we work, live, play, warehouses that store the materials that we use, hotels. We talk a lot about data centers, medical offices, and healthcare facilities. And everything in real estate is taking a risk. Everything we do to make decisions about real estate investment and managing our properties is about managing risk. And so for commercial real estate, when we think about the key areas of climate risk, again, it's fairly well understood. There's transition risk. Tied to evolving regulatory requirements, increasing customer demand for sustainable buildings, policies tied to decarbonization, such as Local Law 97 here in New York, and increasingly we're talking more about the cost of rising energy and demand on the grid. All of this is tied to transition risk that real estate owners need to think about, so we know what we need to think about, but we'll get into a little bit more about how that works in practice. On the physical side, we know that buildings are exposed to the increasing frequency and severity of extreme weather events, and there's a lot of data available to us that can break down these different areas of increasing weather-related risks and give us data on the probabilities of these events happening, where they're growing, and how they're growing. But where there's still a lot of uncertainty is really about how that will impact the individual building. And so again, there's a lot of information out there on how political winds are changing, economic conditions may change the trajectory of transition risk in different markets. And again, this information is generally available to the public. You can buy climate risk data. Information on regulation and policy is publicly available. But really, when you get into trying to assess the vulnerability for a commercial real estate asset, that's when the building owner that is closest to the building and really understands what's driving value is going to really kind of be able to translate that information into vulnerability and ultimately risk. And this may be, again, based on the location of the asset, the type of building it is, the property sector, or the type of investment you're trying to make. Are you, is it a core investment that's really just generating income and operating on a normal basis, or are you looking to make a big investment and do a repositioning as the previous panel and inject a lot of capital into the building? All of that really kind of plays into the potential vulnerability that is tied to those various aspects of climate risk. So again, thinking about how the building generates income, how they're managing operating expenses, and really ultimately if the building is going to retain its value over time, things like liquidity and price appreciation and the potential for those things to be impacted are all the types of things that owners are thinking about, and then taking steps to mitigate that risk. And that might be through financial tools, such as spreading some of the risk around or insuring against the most extreme events. It might mean making those capital investments into the building to harden against extreme risks, or making investments in energy efficiency or investments in clean energy. All of that is a form of risk taking. As we said, if we had abundant money available, you would likely want to do all of those great things, but a building owner has to make decisions about the level of risk and investment and payback specifically around those things. And I know JP and Max are going to get into more specifically some examples about how this is showing up in practices. But because real estate is not only about the buildings, which are a fundamental part of our lives and communities, but also because real estate plays a critical role in investment portfolios. Stocks, bonds, real estate. That's how we think about it at Nareit. And we spend a lot of time talking to investors about the importance of real estate within investment portfolios that, again, really have a lot of responsibility, that fiduciary responsibility. This is retirement accounts and investors looking to generate a return or to preserve the value of their investments. So beyond integrating this information about climate risk into the day-to-day decisions about the investment in the building, a lot of time is spent on reporting. And really that is to provide information on climate risk to investors to inform their investment decisions. For public REITs and many real estate investors, private real estate investors, they have a regulated and fiduciary duty to manage financial risks and provide information to investors that might inform their investment decision. And so when REITs and real estate companies are reporting on their approach to addressing climate risk, they are really focused on that potential for financial impact. So taking it beyond the exposure and the vulnerability and really understanding how might this impact the ability to meet the commitments that have been made to the investors that are investing their capital into the building. And while regulations and global standards and market pressure is really looking to really specify and quantify this level of risk, as you can imagine, boiling these complex issues down across a large, diverse portfolio of buildings can be complicated. Even just as we said, like understanding the uncertainties and measuring it for an individual building, what level of risk an owner might be willing to take. When you amplify that across large portfolios, that can be even more difficult. And the thing that kind of further complicates this ability, and I think is an important part of the discussion when it pertains to commercial real estate, is the difference that might exist between investment strategies as well. So how risk is managed or mitigated for various financial stakeholders in a real estate asset may look different. So an indirect investment through as a shareholder in a public REIT or a limited partner in a private real estate fund might look very different from somebody who is issuing debt on a building, maybe longer or shorter term debt, depending on the vehicle. And then as we talked about, the direct investor in a building making decisions about the day-to-day management and capital investments in a building is also going to be looking at those same risks and opportunities in a different way. So the capital stack for an individual commercial real estate asset may include many different financial stakeholders with different expectations for returns on capital, different time horizons for their investments, which leads to differing levels of financial risk across the same building. So when we talk about climate risk in real estate, all of that has to be taken into account. And again, it may look, the same building may look different in different analysis, depending on how you're looking at it and what you're trying to get out of it. And so our panel is going to discuss more about what's working, what's not in the real world, really driving investment decisions in the commercial real estate market around climate-related risks.
Yeah, and with that, we can move straight on to you, Jonathan, if you want to share from your experience at Tishman Speyer, and then Max, it would be great to hear from the institutional investor perspective as well.
Sure. Well, I think one of the interesting questions to ask now is, in our business, is really about the duration that we're going to hold assets and what are the timeframes that we're looking at that risk over. Good news, bad news. Under the current administration in Washington, we can say for certain that we're not bending any curves. We're on a rocket ship to 2.75 degrees. That's where we're going. There's no changing that now. That has been, all the pieces are moving in that direction. And even if dramatic change occurred tomorrow, which it's not, we're barely going to bend that, even if we could. So point in saying that is just we know where we're going. The question is how quickly are we going to get there, and how is that going to impact the various investments that we have along the way, and how do we want to think about where that risk lies? So one thing to think about is, obviously, we tend to, not obviously, but we tend to, and Max, you will further talk about duration in a moment, but we tend to be in assets for anywhere from 8 to 15 years. So we're raising money at the beginning, we're buying those assets, we're doing various things to them, and eventually we're going to sell them. So obviously we need to think about the risk in that time frame. But we also need to think about the risk for the next owner, because at the end of the day, our business is generally a value add play. We're generally buying assets to do things to them, renovate them, release them, do capital works on them, et cetera, we're generally selling those assets to people who do not want to do those things, that because we have done them. And you're buying an asset that now has new elevators and new lobby and whatever it might be. Point of that story is the next owner has that same set of risk. And so if, for example, we buy an asset that we know has a certain level of risk, are we going to future-proof it, or are we going to sell that along and hope that the next owner wants to do that, or maybe doesn't care about that, or maybe hasn't realized that yet, that that's a problem? But certainly thinking about that and knowing exactly what part of the world you're in when you're doing that. Potentially, if you're selling that asset in South Florida, maybe nobody cares. Maybe they should. But if you're selling it in the Netherlands, they probably do and are thinking about 3 owners ahead. And so how are you thinking about where that risk lies is critical into how much you want to take that into account in your investment thesis. There are lots of places that 50 years from now look not so hot, but if our hold period is 10 and the next owner is 10, the sad reality is if we can only look 20 years into the future and the problem comes in year 53, we're just not going to be the ones to spend the money to solve that problem, more than likely. And so thinking about that lens of duration on top of this risk is really a lot of what we think about in regards to physical climate risk. I'm going to put transition aside for a moment because transition risk comes with a whole different set of considerations and the timeframes are much more variable. Meaning on the transition risk side, we're really talking about what governments and other, entities run by humans are going to do. And it's much more difficult to judge what might change in the future, what the duration might be. If you were sitting 4 years ago, you would probably not necessarily guess where we would be today in the conversation about climate risk in the United States and maybe globally. And so on the transition risk side, it's a lot harder to look out into the future and gauge correctly. On the physical risk side, it's much more possible, and it's much more as Jessica was mentioning, there are tools, there's data, there's all sorts of things out there to help you guide on the physical risk side, and it's really deciding where you think that risk exactly lies. There's also a bunch of other factors to think about when it comes to physical risk. One being, for example, if you know that a point on the map in Miami is just as likely to have a hurricane as a point on the map in Houston, are those really the same risks, right? And are they, in fact, the same way to look at it? And what I would tell you is there's lots of other factors that we've tried to work into thinking about that. A lot harder to do that because they're less standardized, but simple example would be in Florida, when the lights go out, power comes back on, generally speaking, within 12 hours. Not to call it any particular company, but for whatever set of reasons, Florida Power and Light's quite good at keeping the lights on. Power goes out in Houston, come back in 5 weeks, maybe you get power. And so, it's just as likely that that hurricane will strike that point in Houston, but if the likelihood that the power is out for a much, much longer period of time, that's going to change how you think about buying assets in those places. And hey, if you own multifamily in Houston, the people living in your multifamily building do not care. It's the governor's fault. They would like to know when the power is going to be back on and they're cold and they want to cook dinner right now. And so as a landlord, you have a different set of variables in thinking about that and in thinking about not just that, again, physical risk, but what happens when that happens, how do you want to price that in, and what are the various other factors that go into thinking about that. I'll give one other fun example. We built a development in Boston called Pier 4, which was a residential condo development and a large office. It was built for the 150-year floodplain. It's never come close to flooding. However, it connects to the land, and where the land that it connects to, which we were not part of our development and is owned by the Boston Seaport Authority, regularly floods. And so guess what? We built a fantastic island, and it's really great if you want to live there. But the challenge is the piece of the puzzle that we didn't control is the one that now is the challenge. And so in thinking about those additional challenges beyond just, again, the actual physical risk at that exact location, but things that are going on around it and how much of that you can control all goes into that set of thinking about physical risk. So I will leave it at that and hand it over to Max, take it from there.
Thanks. So I think, I like the way you were framing it, and if we're going to build on this a little bit, I'd like to take a bit of a step back as well. If we're thinking about as asset managers, who are we doing this on behalf of? What's driving this? How do we really determine these investment decisions we're making? We need to think about that responsibility, the fiduciary responsibility of what we have. So we're investing on behalf of pension funds, insurance companies, you name it. And these notions of resiliency, of physical risk, transition risk, are increasingly becoming part of that conversation. Thinking about, are we measuring risk? Is it something that we're able to assess, even at times getting down to the questions of each individual property. What's your exposure to flooding, earthquakes, wildfire? So we need to make sure that we're well equipped to be able to address these. The other part is, again, thinking of the duration is what does this mean in the long term? You know, a lot of these risks, these issues look at a 50-year, 100-year time scale. And that's very difficult to start thinking about, okay, well, I need to make an acquisition this year. I need to potentially sell an asset. What will the market say? How is this being priced in? So there's different ways that we can start to look at this. One is we start thinking about the liquidity of our properties. Well, what market are we selling this into? Who's a potential buyer? Are there regulations in place that dictate the level of energy efficiency that we should have? Now, here in the US, obviously it's a very fragmented market. In the EU, there's a little bit more, let's say, similarity in how we're assessing these. But just to give you an example, in the UK, where I live, unless your building has a certain energy performance certificate of a specific level, you can either no longer lease your property or even sell your building. So again, these are very real conversations you need to have today to ensure that you're future-proofing or the longevity of that potential income. So some of the factors here. Now, we were talking a little bit about transition risk. We alluded to this slightly, but I think that's an area where we could really start to get behind the understanding of what tools are out there. How do we start to measure our portfolios? So in thinking of the big picture as to how this really implements and affects our day-to-day operations, it's that. How do we upskill our investment teams? How do we upskill and raise awareness to what some of these challenges are? And that's probably one of the areas we're going to be focusing on quite a bit for the years to come. You know, realizing that this is at times a local market, but we're investing on behalf of a global client base. These are investors from all corners of the globe looking to understand what are material risks, how is that factored in, and again, how can we ensure that you as an asset manager are assessing all possible risks and opportunities within the portfolio itself. So I just wanted to leave it something really high level like this for now, but just to give you a slight picture as to, again, what this starts to mean in terms of a day-to-day affecting our operations and diving deeper into how this might be affecting our asset management.
And I just want to add one comment on the upskilling. I think that's a major challenge that is not well understood in the United States because the problem is probably the United States. A public school trained pharmacist in Switzerland knows more about climate than 99.98% of all Americans. And so we just have a massive gap in education and understanding how any of this works. We don't have the science, we don't have the public policy knowledge. We got nothing. And so when you talk about upskilling investment teams, these are all very smart people, but they have managed, because we are in this country, to get through their entire educational cycle without learning anything on climate science, climate change, or any of those things. And so the upskilling problem is very, very much there and is not easily solved.
I was just going to say, I think I'm not going to quibble with your assessment. I'm not an American myself, so I'll keep my mouth shut. But I would say that the whole idea when we talk about fiduciary responsibility and that notion of knowledge, if there's a penalty put on ignorance, then it will be solved. If there's no penalty put on ignorance, it will not be solved. And the difference between what you and Max are talking about are cultural, they're social, but they're reinforced and underlined by economics. The kind of regulatory hammer being used to say, it's not a nicety to have electrical efficiency, it's the price of doing business. It's your social license to be able to hold an asset and make profit off of it. That is a very different approach to what you're talking about. And until and unless that gets solved, there's no incentive for anybody to actually bother to change something deep-seated like the K-12 education system in any country.
Maybe just to jump on that, I mean, even if you look at the RICS, the Royal Institute of Chartered Surveyors, in 2025, they updated their Red Book guidelines in terms of valuations to incorporate ESG or sustainability-related measures. Now, what's the real impact of that right now? Well, the valuers we work with, they're asking much more in terms of details. What type of equipment's in the building? What are the energy efficiency levels? So it's still, I think, going to take some time before that really starts getting priced in. But in terms of those international valuation standards, they have evolved and they are starting to incorporate that. So that's, again, something where we can see that there are pieces in motion, and sooner than later, this is going to start taking an impact again. Very much looking into the actual economics here. What's the valuation of these properties?
Thank you. That was really interesting. There's a few bigger topics that we can delve a bit deeper into that have been touched on already, but I think maybe the first, if we could get a bit more granular about risk pricing and valuation, perhaps another question for Jonathan or Max, but feel free anyone to jump in. And just, yeah, could you tell us a little bit more about the mechanics of that process, data modeling, any of those?
I'll just say briefly that, obviously there's one thing to say Rick's saying this is how you do it. The reality is it's whatever the market ultimately is going to, trade the asset at. And what you see today is that in some parts of the world, those considerations are very much priced in, and other parts of the world they're not. Those risks are not different. They could be different based on the actual physical climate, but the actual risks themselves are unlikely to be different across those markets. That's just people correctly or incorrectly pricing that risk. Although the reality is, what's correct even mean in that regard, right? If that's what the market bears and that's what people want to do, then so be it. I think we've entered into an era where, at least, well, I wouldn't say just in the United States, but I think we lead in this regard, regulation is not coming to save you. And so what is going to potentially drive outcomes is changes in pricing. And that has not happened in a lot of markets in the world yet. It certainly has in some. I would argue in the US, very, very few examples of that. But the risks are no less real in the US than anywhere else. And so arguably there's a lot of mispricing, although easy for me to say, because ultimately plenty of people who seem to have mispriced that risk have made boatloads of money along the way. So obviously that hasn't had a severe financial consequence today, at least up until now. But you look into the crystal ball into the future, and it certainly looks like that's a very real possibility. And it looks like it's a very real possibility in a number of parts of the world where you could certainly argue that it sure seems like the risk is being vastly underpriced. But it's again, the eye of the beholder. And again, here in the United States, for certain, regulation is not coming to force that sort of valuation in the actual end of the day sale. You could argue maybe insurance prices and markets will drive those assets to some kind of reckoning, in the sense that the cost of insurance goes up and that nicks your NOI and decreases the value of the asset. But again, that hasn't happened appreciably enough yet to drive real change. Even in markets where you should see that, insurance, even with insurance costs going up significantly, places that you still think should be rather risky, lots of institutional capital is building brand new glass shiny towers in places where you think that you should be a little bit more worried about an asset that you hope to last 50 to 80 years, and the risk looks pretty scary in year 30. But maybe, if you can get out in year 10 and you send it to the next person who's not pricing that risk, and you get out just in time, it all works out great, or maybe you don't, right? I think we're about to find out a lot more in the next couple years as to people getting out or in time or not in time in terms of what those risk profiles look like.
I would come in on that, and I think something that you mentioned, if there were any of my students in the room, which I very much doubt there would be, but is the notion of real risk. And I tell my students all the time, risk doesn't exist. Risk is something that we've created. It's a construct. It's a fictitious commodity. We narrate risk. We don't actually measure risk. And I use the analogy of temperature. You can measure temperature. You can use an arbitrary scale. You can do it correctly with Celsius, or you can do it incorrectly with Fahrenheit. It doesn't really matter. There's a fundamental, essential thing. It's the movement of molecules that creates temperature, and we see that manifest as heat in the environment. It's not the same with risk. There's no risk particle out there. There's no movement of threat particles that makes up risk. It is what it is. It is what we say it is, essentially. So it's not so much that there is a correct answer out there and that we're getting it wrong or getting it right. We can't see beyond the threshold of the future, and that's where that uncertainty ultimately lies. It's hard to assume that there's a correct price to something. As you say, the market price is the correct price, in and of itself. Danger is real. The fact that somebody loses their shirt isn't really going to be the consequence that you're talking about. It's going to be that we're, up to our proverbials in water or whatever. But I think we have to be a little bit careful that risk isn't this real thing that we can get a hold of, and somebody's got a better understanding of it. Somebody who bets on red or bets on black doesn't actually know what's happening. They just happen to get lucky or unlucky when the waveform collapses and the future actually kind of occurs. So I think it's a really big corrective that I try to make to my students, that we're not actually measuring something, but we're actually using that, we're commodifying that uncertainty and turning it into a dollar figure or a social figure or something else.
Jumping into this one, I think what we also see is an absence of really having true standardization. It's going to be very relative to who you're dealing with. We've seen, for example, potentially some let's say other managers out there might be assessing the priority or importance of building certifications. Say, hey, listen, we might see a price chip if you don't have a LEED Gold, but rather LEED Silver, or maybe it could be about CREM, the stranding year of a building. There's so many factors that are out there that could lead to decisions here. So you get a bit of that variance in the market. The other thing is, if we're really looking at what some of the challenges are, is if we think about something like physical risk. There are a plethora of data vendors that are out there providing you assessments of the physical risk exposure of your portfolio. Working with several of these at Invesco, but also speaking to our peers, looking at the industry, the correlation between a lot of these data sources is actually pretty slim. So it kind of goes to the question maybe we mentioned earlier as to, what does truth look like? That's where maybe the beauty of this being a real asset is the fact that we can get an assessment of what the theoretical risk exposure is, but we have the benefit of being able to actually see the property, go on site, look at what's happening, not take it at face value per se, but really do that deeper dive. And I think that's something that the industry is also getting their minds around, is that, look, there's a deeper dive that we need to have here. It's a real asset. It's something that can be managed. So how we go from here is certainly the next chapter.
And I'll just jump in with one more comment before you go to the next question, and just really emphasize this point that what the building trades at and that actual market data is the truth about what's happening in the real estate market. And to JP's point, and to kind of touch on this idea of uncertainty, people are what are really making these decisions, right? When you see some of these markets where, you think from the climate risk data, wow, you would think that this would be a riskier market, but people are still going to those markets. People want to live there, and businesses want to be there, and that's making a big difference. So this idea about customer demand and what customers are willing to pay for a more sustainable product, and also where they want to be, is really what's driving a lot of the value in real estate, and sometimes feels disconnected from the climate conversation. Kind of go back to JP's comment about the education not really being there. That's not what's driving decision making for most Americans, where they live, where they work, where they shop, and vacation. And so that's what's connected and really driving those values in the market.
Look, I'd just say you could argue that it's the government's job to solve that problem or not, right? There's all different views on that around the world. There's not one answer. Should the government protect everybody from taking those sorts of risks? Obviously, in this country, we've decided the answer is no. And so the market will price those risks appropriately or not, and that's how it's going to go. There are other countries where they've decided that they should take steps to regulate that in a way that drives those outcomes. Max briefly mentioned about CREM. For those that don't know, it's called the carbon real estate. It's a measurement of carbon on a per asset basis over a period of time. And I think the only point in saying anything about that is just to say they will draw a line in the sand and say, when you pass this year, whatever that is, the stranding year, that is, your building is now stranded. But back to the point about risk is entirely in the eye of the beholder. I mean, the elevators still work, the windows still open, the garage still operates. Your building could be 10 years past the CREM stranded year, and you could be still making $150 a foot in rent. There's nothing stopping that from happening. That's just the concept that you should be aware that at that point, lots of smart people think that might not be a very good investment. But hey, lots of other people might think that's a great moment to buy that asset and make a bunch of money before it washes away in the future. Who knows? But risk is very much not a single thing that can be quantified in a way that can be easily traded amongst different folks. Meaning, if I sell that asset, is the buyer appreciating that same way that I'm thinking about it? Probably not. And at some level, I need to understand that to be able to position my asset to be sold in the future. But does it actually matter? Is a very interesting question. Or do I just need to position that asset for the next owner?
I think there's another counterpart that we haven't really brought up, but it's worthwhile to mention as well, is, of course, the occupier. Who's going to be in the building itself. Now, is every corporate tenant out there looking for buildings of a certain energy efficiency level? There's an increasing number. If you look at the growth in companies with science-based confirmed targets, that is an increasing piece that we have here. It's again, conversations that we have very much seen as well, where occupants will look for building of a certain criteria. It has to be at least X level of certification or X level of efficiency. It's not the entirety of the market, but again, a growing piece or weight that we have to consider with respect to who are we providing these buildings for. yes, we want to make sure we're generating income and revenue here, but also looking at making sure that it meets the future of what occupiers are looking for.
Yeah, I'm just sorry to keep this for just one more minute, but I'll just say, like, if you look at a market like London, we cannot lease a building with a gas boiler in London. That's not where Class A tenants are going. In New York, that is not a conversation that is generally discussed, except in the context of fines as it relates to future carbon legislation. Whereas in London, that's not about fines. It's about buildings that have gas-fired or fossil fuel-fired systems are either unleasable or are getting rents that are far below what they should. That's just where that market is now, and that's driven by the occupiers. That is not what has happened in plenty of other markets. But back to the occupier point, that's very much what's driving that conversation.
I just want to move on. This is a great conversation, and let's keep going. But to move from risk to a conversation about resilience and what that looks like in practice, I think we should get onto that. And if Jessica, you could start us off maybe with a conversation about what pre-disaster mitigation strategies look like. But again, an open question.
Yeah, I'd be happy to. And again, I think that this discussion of resilience is fundamental to real estate, right? Even before sustainability has grown to the role that it plays now in our industry, ultimately the role of the building owner and operator is to create value and to protect the occupants inside the building. And so understanding the environment that the building is in is core to real estate investment. And so not only understanding the kind of financial market and the leasing market, but also understanding the weather, the risks, the vulnerabilities. I'm from Washington, D.C. We think a lot about security as here in New York. So what are the risks that are related to the building, the occupants in the building, and what are the things that you're going to do to protect life and protect the structure of the building? And so as we look at climate risk data, understanding how those risks are going to change. They exist now, they're shifting, they're changing in different ways. And so hardening the building and understanding that communication is a big part of it, as we see during extreme weather events or other risks that are presented, that making sure that you're able to communicate with the occupants and the staff running the building is a key part of developing that resilience plan. And then that ability to make decisions about a large capital investment in the building really has to go back to what we were just talking about, is how are you going to recoup that? If you're warding off a risk, the payoff is in that negative thing not happening. And so how are you demonstrating that within the ultimate financial performance of the building?
Yeah, and there's something I know we're probably coming close to time soon, but I think there's an aspect that we've been having a lot of conversations around, is just what does it really mean to have a resilient portfolio? Now, obviously, our panel session right now is about climate resiliency, but if you think about that long-term portfolio resiliency, is that what? Economically? Is it environmentally? Is it socially? You know, there's a comment you made earlier about these are buildings where we live, eat, work, play. If you think about what is that long-term trend, well, if you think about multifamily, well, what type of place do people want to live in? There's going to be amenity, it's going to be cost efficient. Generally, these are criteria that align with sustainability. Same thing for an office. You know, do you want a building with cubicles, maybe quite stuffy, or do you want an airy air environment? So again, thinking about, how do these sustainability factors or sustainability strategies build in the overall thought about the resiliency of that portfolio, that longevity of the properties and the buildings themselves. Now, right now, obviously, the conversation is very heavily focused on climate, but I think that's a starting point as to, again, that there's that resiliency of the portfolio in the short, medium, and long term.
I think the watchword I would use alongside resilience is responsibility, and I think this has come up a couple of times. Whose responsibility is it to be making those kind of, let's say, long-term or more focused on externalities? Is it the government's responsibility? Is it the current landlord? Is it the current owner? Is it the occupiers in some kind of demand-driven side? In some ways, the resilience conversation has done a very good job of shifting responsibility to current individuals as opposed to other potential owners of that responsibility. So I think anytime we talk about resilience, we have to be very careful. In some senses, it's a shifting of that the locus. Mary Douglas, an anthropologist of risk, says that at the end of the day, risk may be a new modern phenomenon, but it really focuses on three kind of eternal things: purity, fear, and blame. And it's just a newfangled way of dealing with this. So if we're going to be talking about terms like resilience or abundance or whatever the buzzword of the day is, we have to be very careful. How is that actually changing who's holding the penny at the end of the day when the music stops, to mix about 4 different metaphors there?
Thank you. Just quickly before the Q&A opens up, I just want to get a quick answer from each of you about what looking forward means to you, how you would understand the best ways to manage climate risk more effectively going ahead.
I can start. I think the first thing would be remembering that climate change is not happening in a bubble. We have a lot of things happening across the globe and here in the U.S. that are impacting the value of real estate and decision makers for capital allocators, building owners, and individuals making decisions about where they're going to live and work and rent. And so I think that's really important. And then the key thing that I think has come up in a few of the answers has been around this ability to consistently price in. The data that's available needs to be consistent, comparable, decision useful, all of the things that you hear about, financial disclosures, in order to truly impact the price of real estate. And then you can really look at that market data and say that sustainability has been priced in, and that you can start to draw conclusions and you can start to use that to make future investment decisions.
I guess I would say, I think a lot of the conversation focuses around understanding one particular system, which is the market, and understanding the vagaries and kind of making bets on that particular piece. But it completely ignores the fact that the other system that we're talking about, the climate, doesn't care what the market's doing. The pricing of an asset is an interesting kind of phenomena in one system, but it's completely irrelevant in the other. And I think sometimes we lose sight of this. Again, talking about how much could we optimize the square footage, the price per square foot is in some ways esoteric to the underlying other system, which is what's the climate going to do? And again, 10, 20, 30, 100 years, in the long run, we're all dead, as Keynes would say, but I think that's where I would try to change the focus, but I don't really have a convincing way of, I think JP's made me more pessimistic than I was when I started this panel, which is saying a lot. So that's where I'll end that.
Do you, Jonathan, Max, have anything to add, or we can open up to questions?
We can go to Q&A.
Hi, thank you for this great panel. My name is Benjamin. I'm a current grad student at SHAG. So there's projected to be great climate refugees and climate migration patterns. Do you already see investors trying to anticipate those migration patterns into market where they are going to allocate capital?
Great question. I mean, I don't think so. I mean, it's not really, I mean, if anything, it's become harder and harder to predict how any of that would play out politically. Borders have become much harder, not more porous over time. And so, although what you say is very likely to occur, how that actually goes down is very, very unclear. And so, you could make a logical statement like there's 1.45 billion people in the Indian subcontinent today, and that looks maybe a lot of it to be uninhabitable in the future. But if you're in the Indian subcontinent, there's kind of nowhere to go. There's ocean on two sides, there's mountains on the top, and there's some unfriendly countries on the left and right. So it's not clear that that actually happens, right? So my only point in saying that is it's a logical statement to be made that that seems very likely to occur. But exactly how that plays out and where those people go is very, very unclear. And so I think it would be, at least we don't see evidence of that in investment trends today. I mean, you could argue things like, well, Dubai's a good bet. It's warm, it's nice. I mean, that's wealthy people that can pop over borders can do that. You can call that stream. But the question you're asking is much larger, and I don't see evidence of that today. But I'd be very curious if you see anything like that.
Hello? I think we probably have the same observation. It's something that is played out over the long term. How it'll happen mechanically, don't know yet. But certainly we see a lot of the science, a lot of the reports do tend to lean towards that type of conclusion. But time will tell.
Yeah, and I think that I totally agree with what has been said about over the long term, big picture. I think this is part of the climate story. But I think in the short term, what we see is migration within communities. And so you might see people kind of moving a little further from the coast or moving to a community where they feel is more resilient than another community, but not kind of moving across the country or moving to a different country. We haven't reached that tipping point yet.
Anyone else have a question?
Yes, hello. Thank you very much for the insights. My question would be on regulation. So the European Economic Area has market caps on carbon, but the US does not. And do you think the weaker regulation is worth it for the market, even though it's worse for the environment?
I'm not going to answer that question directly because we have business in all of those markets, and I don't think we have an opinion on that per se. But I do think that the vastly different set of regulatory structures in Europe and in the United States, I can say, are causing all sorts of problems. And that is not, we as a global investor, we would love everybody to have a more unified opinion of how this all works and how we should proceed. So to say that obviously the Europeans have taken a very different regulatory approach is an understatement. But I don't necessarily think that that's a bad thing or a good thing. I think from our perspective, it's just one more thing to figure out how to work into the model and to figure out how that applies to our LPs and how they want to think about our investments. But I wouldn't say it works or it doesn't work or it's good or it's bad. I think it's just more about what everybody agrees is that what they want to do, and we'll work around that. I don't mean to give a squirrely answer, but we don't really have opinions in that regard. I don't know if you have a different take on that.
Same perspective. And also, I would say, looking at the EU landscape right now, there's quite a lot of change going on. There's a lot of, let's say, simplification of some of the reporting standards and requirements out there. But ultimately, as it goes to the built environment, we have our role to play. There's what work we can do with the buildings themselves, and what that means for other sectors and industries. That's, of course, for every stakeholder has their responsibility. So.
Yes.